more now on our top story this morning. Citigroup is planning to sell or split off its $10 billion unit, Citi Private Equity, and this is expanding the list of businesses that Vikram Panda, the CEO, is disposing of to shrink the balance sheet, reduce the company's risk. Bloomberg's John Keehner is here. He's one of the two reporters who broke the story. Jonathan, let's talk about the motivation here, because we hear so much about what the president is trying to do, but as you've reported this morning, the plans were in motion before Obama came out with that January 21st announcement on new bank regulations, correct?
That's right, Eric. It seems to us that these plans were actually in place in the prior year, before Obama came forward. What's interesting to us is what that does to this sale. There's the potential that these types of units might now flood the market if banks start to unload them. So is it possible that Citi has to move ahead on this one to get it out, or is it possible that the market becomes too flooded and they really struggle to move it out? That's one of the things that I think the Citi managers will be debating right now.
Is it possible, as a result of that, that Citi may have a rare advantage? Vikram Panda just told me last week in Davos that he doesn't have a concern about the president's plan because what Citigroup has been doing dovetails so much with what Paul Volcker has intended.
Another part of what we reported is that actually only $2 billion, we believe, of Citi's own money is in this group, meaning $8 billion is from outside investors. Now, interesting, that means that there's quite a bit of management fees coming out of this unit, so it could be worth something to someone. It's possible the current managers might be able to find another sponsor to partner with, or even borrow the money to take it over. So you might see some sort of a management-led buyout, perhaps like what we saw with some of the Lehman units that were spun out as that bank started to go sideways.
How do you actually get a deal like that done these days, a management buyout, given the fact that we're talking about private equity, an industry that has been bruised? You're talking about financing, which isn't easy to get, even for the private equity guys themselves.
And this group also invested in Cerberus, some of the big LBOs that clearly did not work out. That being said, you do have a pool of capital and committed fees going forward. We don't know the exact amount, but likely in the tens or hundreds of millions of dollars. So that's something that perhaps a hedge fund or a sponsor could hook up to them with, and maybe they could spin that group out. They could even try to raise new third-party money for this. I think the appetite for new third-party money will be really telling for groups like this and others that are spun out of these banks this year on the heels of Obama's plan.
Let's talk about the risks here. What, if anything, could go wrong with this plan?
Sure. Well, as far as the unit itself, what could go wrong is the strategy. It's a strategy of co-investing with other private equity groups. Clearly, that hasn't worked out too well. And broadly speaking, they have a lot of legacy assets in highly levered LBOs that may or may not work out. We've all been watching closely to see how these deals can spin out in the current credit environment. What could go well, of course, is a recovery in the private equity world. These are experienced managers, and they certainly have the ability to fundraise and have done quite well over a 10-year period. So,
Jonathan, congratulations for a great scoop. Very glad you could join us here this morning on the Inside Track. That's Jonathan Keehner, everybody, on Citi's plans to sell Citi Private Equity.